All right, welcome back. Today we got a stock market update and we're going to go over the CPI numbers and some other data points that we got today. So today was the CPI 5:30 this morning, and the CPI came in hotter than expected at 0.4% increase in March and a 3.5% annual increase. So year over year, inflation is up 3.5%, which was also hotter than expected. And we also had a bond auction today. 10-year yields or 10-year bonds went up for sale, and that was not a good auction. Not a lot of demand there. And most likely there was not a lot of demand because people are seeing oil, the dollar, gold, commodities are rising, means inflation is rising. So the likelihood of rate cuts in the near future seems less and less every single day, meaning that interest rates will be higher for longer. We've talked about this. Not a lot has changed, but we're seeing huge moves in the 10-year in interest rates. So the market is beginning to reprice the interest rates that they had priced in recently. So let's take a look here. Let me pull up the 10-year yield. Just look at today. I mean, really shooting up. So a while back, we drew this red line here saying it looks like yields have topped. Now that could be a relative top, could be the top. We don't know. So now we've got this green line here. It looks like rates kind of bottomed out and are making another push higher. During this red decline here, we saw a lot of slowing in the rate of inflation, and now we're starting to see it speed back up. And the big scary part here is, to me, is oil. So oil's made a really nice move from 70 up to 85. And what's the problem with oil rising is the Fed has nothing to do with oil. They can raise rates as much as they want, and that's not going to really change the price of oil. That's a supply and demand game, and OPEC has been cutting supply, and we're about to run into the summer months where typically demand is higher. So keep an eye out on oil. What would be really nice for the market is if this is just a bounce in a downtrend. Who knows? I don't know. Commodities are they're hard to play. Just look at copper. They're hard to guess. Nobody knows. And interest rates are hard to play. They're hard to forecast. Jamie Dimon, the head of JP Morgan Chase, did a letter to his shareholders, and he's saying that rates could be from 2% to 8% on the 10-year. So the head of the largest bank in America, they don't know where rates are going to go. So there's a big spread on where we could be. So as I've said before, I think the market keeps rallying. I think inflation stays hot until we hit a recession. Now, ironically, higher interest rates may push us into a recession. So if this keeps climbing, it's going to keep putting pressure on the real estate market. It's going to keep putting pressure on the auto market, and anything that has to do with financing. So we'll have to wait and see how things go over the next few months. But it wouldn't surprise me if we kind of get pushed into a recession, which would cool down inflation. So that is what I'm looking at. But if we look at the NASDAQ, a little bit of pain today, but we're still in a nice uptrend. So we could be rounding off here and topping out, but who knows? We could shoot back up tomorrow. Tomorrow we do have the PPI numbers, so that'll be interesting, but definitely strong uptrend here. Once we break this green arrow, that's when it's like, okay, maybe we're starting to have a market structure shift, but we'll need some confirmation from that. So we'll just have to wait and see, but definitely looks like momentum is slowing, as we've talked about in the past videos. So action items remain the same as we've discussed. There is more pressure coming to the interest rate sensitive sector. There was one stock I wanted to pull up because it really shows that. Because we know Tesla, Enphase, things like that have been hurt. But Vici is a REIT, and they're getting killed. So I would imagine that a lot of other real estate, boy, just pulling up the real estate sector I have, yeah, they're getting smashed. So real estate has to do with lending. So interest rates higher means less activity in that sector. So action items stay the same. We are looking to build cash and be ready because the market needs to reprice all the rate cuts. So rate cuts are less likely in the near future, and the market needs to reprice that. And I think we're in the beginning of the repricing of that. So building cash to be ready and liquid for when the market does reprice, and you can buy some Amazon on a discount. And when I'm building cash, I'm not selling anything. There's no positions that I want to sell. I'm selling calls against my stock, and I'm doing a little bit of trading to build some cash. But I'm not aggressively buying, as we've discussed, but looking to hedge with options by selling calls and even buying puts if I want to be a little bit more aggressive on a stock. Like Tesla had a nice little run over the last few days, and so I sold some puts, or bought and sold some puts, did a put spread, just to hedge myself a little bit more because I'm so exposed to Tesla. So I'm going to lose money when the stock goes down, but I'll make money on my options just so I can go buy some more shares or buy some more Amazon, whatever I'm looking to do. So other than that, not a whole lot to get to. Same action items, but today was a big day in the market just because we're seeing the data. We're seeing the price actions not lying here with oil, with rates, and we're seeing the market kind of stall around. So I'm really interested for earnings because earnings could also be a little saving grace here. There could be a little bit more gas in the tank for the market in the short term. But again, I still stand pat at that we are going to rally until we hit a recession, and who knows when that'll be. So in the meantime, be safe, be ready, keep an eye on oil, keep an eye on rates, and I will keep you guys in the loop with what's going on. That's all I got. Peace out.